Vodacom has suffered a profit knock. The mobile network operator has posted a 19% decline in half-year headline earnings per share. That's largely due to currency depreciation in Ethiopia. One-off costs in its international business also weighed. CEO Shamil Jusuf says while the firm's bottom line took strain during the period, he is confident that Vodacom is poised for a stronger second-half performance. An interim dividend of 285 cents per share has been declared. That's down 6.5% on last year's payout. Omnia has managed to increase its half-year profit. Headline earnings per share ticked up 2%. That's thanks to a good showing at its mine-blasting services segment. That division helped to offset the impact of a drought on its fertilizer business. The firm has described the results as strong, saying it underscores the resilience of the business amidst a challenging macroeconomic environment. Sterling, that's how Raubex has described its half-year results. The Infrastructure Development and Construction Materials Supply Group has delivered a near 50% increase in headline earnings per share. That's thanks to strong performances across all divisions. An interim dividend of 94 cents has been declared. That's a 49% jump on the previous period's payout. Looking ahead, Raubex is optimistic about its prospects, particularly in South Africa, thanks to positive market sentiment and anticipated economic growth. The firm says it also has a robust tender pipeline for the remainder of the year. Woolworths has reported higher 18-week sales. Turnover increased to 6.5% during the period, while concession sales rose 6.8%. The retailer says while discretionary spend remained relatively constrained in South Africa, consumer sentiment is improving. That's as inflation moderates, interest rates begin to ease, and load shedding has been suspended. Life Healthcare expects to present a strong full-year results to the market. The private hospital operator says headline earnings per share from continuing operations to be as much as 61% higher, while HEPS from continuing and discontinued operations are forecast to rise by as much as 77%. More detail will be made available when the company opens its books on the 26th of November. Harmony Gold's Ava copper mine might produce more metal than first proposed. The miner, which is finalizing a feasibility study for the Australian project, says it could produce 50 to 60,000 tons of copper from Ava. Those comments accompanied a first quarter update. Harmony's described the performance for the period as exceptional. While production dipped 1%, group operating free cash flow jumped 60%, supported by a higher gold price. Harmony's added that it's confident of achieving its annual guidance. Sibanye-Stillwater has come to an agreement with unions at its South African gold mines. The parties have inked a one-year wage deal. This allows for a 5.5% increase until the end of June next year. This is in contrast to the 5-year agreements that other miners have signed. CEO Neil Froneman says the one-year deal is more prudent and fair given that the firm's gold operations have undergone significant restructuring and so have not yet fully stabilized. Pick n Pay has released the details of the long-awaited initial public offering of Boxer shares. The price range for the offer will be in the range of 42 to 54 rand per share. This will give the company a market cap of between 21 and 24.7 billion rand. Pick n Pay is expected to retain a majority stake in Boxer, holding as much as 65% after the IPO. Boxer will list on the JSE on November the 28th. FlySafair has filed an urgent interdict against the SA International Air Services Council. That's as the low-cost airline seeks to avoid international flight cancellations. The issue of contention relates to a recent ruling over FlySafair's shareholding structure, which the council says is not compliant with the law. SA's aviation law limits foreign ownership in domestic airlines to 25%. But Ireland-based ASL Aviation Holdings reportedly holds an interest of over 74% in the carrier. FlySafair has assured customers that it's trying to avoid any service disruptions. In international news, China's semiconductor index leaped close to a 3-year high on bets a U.S. order halting Taiwan semiconductor manufacturing co's shipments of chips to Chinese customers could accelerate Beijing's self-reliance efforts. Here's more detail in this package report.
China's chip index leapt to close at a 3-year high on Monday. That's on bets Beijing will accelerate its chip-making efforts, after the US ordered Taiwan's TSMC to suspend shipments of advanced semiconductors to Chinese clients. Reuters reported that the chip maker will halt shipments from Monday. Analysts said that while the move might lead to some short-term pain for Chinese firms, it could boost the domestic sector, specifically those companies involved in making chips for AI and graphic processing units. The CSI Semiconductor Index jumped more than 6% during trading on Monday to the highest since December 2021. Shares in SMIC, China's largest foundry and the country's main alternative to TSMC, rose more than 4%. Many rely on Taiwan-based TSMC, the world's leading contract chip maker whose clients include Apple, for production. And now it joins the list of other chip makers, including Nvidia and AMD, that have been barred by the US from selling to Chinese clients. In response to these restrictions, Chinese firms and chip designers have in recent years sought to design their own advanced processors.
And German policymakers have tried to salvage its industry champions. This may have resulted in them overlooking the untapped growth potential of the country's services sector. Here's more in this package report.
The German economy used to be described as Europe's growth engine, but it's underperformed Eurozone peers since 2018. It's now facing further pain as car giant Volkswagen plans to shut factories at home. Adding to the woes, Germany's governing coalition collapsed last week, capping months of wrangling over budget policy and the direction of the economy. According to Reuters interviews with 12 executives, entrepreneurs and economists, Germany is overlooking an untapped growth potential in its services sector. The sector, which ranges from hospitality to finance and IT, is growing faster than the country's manufacturing industry. And while the segment is smaller compared to that of other European economies, it already makes up the bulk of Germany's economy. Services grew 1.6% in the first half of this year from a year ago, while manufacturing contracted by 2.8%. And the services sector represented 70% of Germany's gross domestic product last year. But business leaders say a suffocating bureaucracy and a culture of heavy regulation is stifling the creation of new companies and new jobs. They say this is particularly true for small and mid-sized businesses. Together, they make up over half of Germany's workforce. Over-regulation is also exacerbating a labour shortage. Half of companies active in Germany's services sector say they struggle to find workers, according to a recent report. Many services sector professions, including lawyers and doctors, require specific legal standards and certificates to practice. But in Germany, the requirements appear to be stricter and affecting a wider range of jobs.